Happy Friday, everyone. Rich Swerbinsky with the Mortgage Collaborative here with the rundown with Rob and Rich, our Friday afternoon walk through the week that was in the mortgage industry. And this week, a couple special guest co-hosts. But before I introduce them, Mr. Krisman, Rob, good to see you as always. How you doing this Friday afternoon?
Good to see you too, Rich. And I know you and I emailed a little bit during the week about sponsorship opportunities. So I approached McDonald's to see if they were interested in sponsoring us. I haven't heard back yet.
Well, there's a Reddit movement trying to go on where people are trying to get people to boycott McDonald's until they pay the employees $25 an hour as like an anti-inflation. You on Reddit, Rob?
Reddit, is that one word or two? So I have a question. I have an interesting observation. I did stop for lunch on the way here to the studio, and I always get a double cheeseburger and a medium fries and a large Diet Coke, light on the ice. And interestingly enough, the medium fries was 20 cents more than the double cheeseburger. Okay, so the fries cost more than the double cheeseburger. I couldn't. That was new to me, and that's a sign of something. And I need to ruminate on that a little bit, Rich, and try to figure out what implication that might have for lenders in the United States. But give me some time.
A long road from when they were like 5 cents in your youth, the cheeseburgers. So inflation really brutal and impacting everybody, even Rob Krisman. So. Yeah. Our guest co-host today. So a lot of stuff going on right now, just operational related issues, volume starting to drop off. Obviously, we're in a very heightened regulatory climate. The whole work from home thing, all this technology that's starting to emerge that, will play a big part in just the mortgage manufacturing process going forward. Wanted to bring a couple heads of mortgage ops in to the show with Rob and I this Friday. And we got a great pair because they both run mortgage apps for very large mortgage companies, 5-6 billion a year. They work for friendly competitors in Arizona. Until recently, they lived literally like a 2-minute walk away from one another. They're friends, and they're both brilliant people. They're going to bring a lot of insight. So very pleased to have with us this Friday afternoon from People's Mortgage Company, their SVP over operations, Katie Klaus. Katie, good to see you.
Good to see you too. And I just want to say I'm still bitter that Mike moved out of my neighborhood. I just want to get that on the record.
Off into the suburbia, the highbrow territory. I don't know what happened there, but good segue to our other guest co-host, the head of operations for VIP Mortgage, Mike Metz. Mike, good to see you, man.
Hello, everybody. I moved 1 mile north of her. It was a long move.
You're out of my zip code. You're out of my zip code. It hurts, Mike. It hurts.
Too funny. So, well, let's get right into it. Rob, still no Fed chair announcement. Your inside sources, any word on when that's coming? Jay Powell, Lael Brainerd, you got any inside info for the viewers?
I think it's whenever President Biden's people tell him who to nominate. Oh, did that come out of me? Sorry. I didn't mean that. I think, the safe bet will be Jerome Powell. I think that's probably, even though, Elizabeth Warren is out there saying he's, questioning his abilities. I think that's the safe bet. I think that's where the money is. And yeah, you're right. Hasn't been nominated yet. The markets, of course, whether they're stock markets or bond markets, they don't like uncertainty. And obviously the Fed chair is a big uncertainty, but I think it would create more problems than not if Biden were to nominate somebody else instead of Jerome Powell, because he's a proven entity. You've got Dodd-Frank out there, saying he's a good guy, he's a good choice. He's obviously experienced. So I think it's a matter of, at what point does President Biden nominate him? Now watch, I said all that, and within the hour,
the news is in. Lael Brainerd just got the nomination.
Yeah, exactly.
Yeah.
So, but that would be, I think the markets would be happy with that, and it would remove some of the uncertainty, which, like I said, markets don't like. So that would be a safe bet.
Well, I know the Wall Street Bets crew on Reddit definitely likes him. He's been pumping money into the economy like a drunken sailor and been great for the stock market. He's been great for the mortgage industry, for that matter, for just the rampant amount of mortgage bond buying. So he's got my vote. Stock market, mortgage market, that's a big chunk of my life. So he's been good for both. So yeah, but a crazy tenure, the most aggressive Fed chair I think ever. He really just aggressively attacked the pandemic and lowered rates immediately. And 4.4 trillion, I think he added to the balance sheet. The inflation thing, I think his legacy will be tied to how bad it gets, and is it transitory? But we'll see what happens. And, we'll probably have more to talk about next week on that. So
Now, hold on, Rich. No, we don't have a show for a couple of weeks.
ooh, that's right, because we got Black Friday next week, and then we're back the week after that. So actually 3 special editions of the Rundown during the 12 days of TMC event. If you have not registered your company yet, 55 sessions over the first 12 business days of December, including a bunch of special ones. Mike, talk real quick before we get into it. The $100,000 hour. This was Mike's. I say all the time, almost all the best ideas on things we do at TMC come from members. Makes my job really easy, actually. But Mike, tell us a little bit about the $100,000 hour that we're going to do as part of 12 days.
Well, one of my favorite things about the TMC conference is when people share just a little snippet, almost casually half the time, that you frantically write down in your notepad and think, oh, I can use that and save a few dollars. So it was an idea on how do you encourage more of that. So the $100,000 hour, the idea is that everyone submits their ideas on how your company can save some money, whether that's secondary strategies a la Chrisman, whether that is operations, whether that's renegotiation strategies, whether that's vendors, some way to save some amount of money. And then we'll go through round robin share. Everyone shares on a quick timeline with the goal that cumulatively, if people are able to apply those, everyone in the group saves $100,000 for their company and wins a prize, which should be outrageous.
160-minute session. We're going to show the average size mortgage lender. We'll scale it to that from the money standpoint, how to save $100,000 in 1 hour. So something we're fired up about and that Mike's been a big part of. So, all right, well, let's get into it. I want to start with the FHA MIP thing, just because it's been, a lot of talk and a lot of news. And as always, for our audience, any comments, questions, thoughts, please drop them in the chat, the Q&A. I see a Gilbert Gottfried comment already. We paid like $800 to have Gilbert Gottfried do like a cameo to promote the 12 days of TMC. It's hysterical. He just looks trashed. I just picture this guy in his basement, just like drinking whiskey and cranking out cameos for $800 a piece, like one after the other. But if you haven't seen it, it's, I'm sure, on our website and our LinkedIn feed somewhere. But the FHA MIP thing. So the HUD MMI fund capital reserve level over 8%, statutory levels 2%, and so it's 4 times what it has to be. Now, a lot of that is tied to home values and being high right now, but it's enacted some debate in the industry. There's been talk for some time, a few years now, about, should FHA mortgage insurance premiums be reduced? New administration, big focus on home affordability. Low to moderate income borrowers seems to make sense. Marcia Fudge has poo-pooed this to this point, but with the new stats, with the reserve fund going from 6 to 8, over 8%, it's reinvigorated some debate. Bob Brokesmith of MBA was on the show a month or so ago. He came out with a real forceful statement saying that, HUD should aggressively examine a reduction. Katie, Mike, Katie, I'll start with you. Just want to get your thoughts on this issue and where you're at with it.
Yeah, I mean, we would love to see a reduction in, the life of loan premium or an upfront fee, something. I understand why they're being conservative, but they're also pushing this, affordability, and we want to get as many people into homes as we can. And one of the ways that they can do that is by reducing those fees. So we would love to see it. And I don't remember when they did this a while ago, but I know there was some kind of reduction several years ago, and we saw a huge increase in FHA applications. I think we'd see the same thing. And our goal is to get, anybody who can be in a house into a house who can afford one. And so I think that would be a good stepping stone. That being said, every time we talk to HUD or when we have a HUD regulator come in here, they are like obsessed with protecting the fund. So I understand why they're being conservative, but I don't think now is the time. And I think if they want to push the affordability agenda, it's a good place to start.
Great thoughts, Katie. Mike, your thoughts?
I'm pretty similar on that one, where I would love to see them reduce, whether it's even just a bit of the upfront MIP to reduce it down to where, a little bit more approachable for people. They're not feeling like they're losing so much equity when they purchase their home, or just help with the affordability a little bit and reduce that monthly. That said, especially as we see, foreclosure rates or pre-foreclosure uptick just a bit, I feel like they're going to go particularly conservative and not touch that. Keep saving up that piggy bank.
Rob, I saw our friend Brian Montgomery, who was the FHA commissioner. He's had a lot of senior positions, really smart, accomplished guy. He just posted something on LinkedIn. I saw it actually a few hours ago on LinkedIn, white paper he jointly wrote with somebody else arguing against it, against reducing the premiums. Where are you at with this issue?
So I think something needs to, I think it would be a good gesture to reduce something on the FHA side. But, when you look at what the industry has been through and the cyclical nature of us as an industry in general, it's nice seeing that, above 8%. I know that there are a lot of people out there who are calling for a reduction. I wrote about it in today's commentary, but I'm kind of a save your money for a rainy day kind of guy. And I probably aim more toward Brian Montgomery's perspective. And, it's nice to have, I think listeners need to keep in mind that when you do something with one agency, it impacts the other programs that are out there. So when you lower the FHA premium, for example, is that program going to be flooded with, or I should say, is a lot of volume going to go to that agency versus Fannie Mae, Freddie Mac, and the others? So really, I know that the private label security movement has waned somewhat. For a while there under Ed DeMarco and we're going to try to phase out Fannie Mae and Freddie Mac and shrink their footprint. In fact, shrink all of government's footprint in mortgage banking and residential lending. And when you talk about lowering the premium in this case, I think that's a direct opposition to that move. But it's in great health, and we could have some tough times ahead. I would like to see some kind of token move, some kind of small move, just to say that they did it. And hopefully it doesn't impact the overall viability of the fund to too great a degree.
Yeah, I mean, it's all government risk really right now. So it's like, how do you want to balance? I mean, we've been seeing just in TMC benchmark, the percentage of overall loans that are government loans has been going down from, like 22% our whole network, 21, 20, 19. I think it's down to 18 or 17% in the most recent months. So we know Fannie and Freddie are going to get more aggressive on the things they're doing in 2022 and beyond. So it's like, where do you want that risk? And, where do you want to deploy essentially government risk tolerance to achieve goals? To this point, the government has been pretty steadfast, like, hey, we're not going to reduce FHA MI premiums. But I don't know, it's going to be interesting to see how it all plays out. Fannie and Freddie are going to be taking on more risk. So maybe the mindset is, hey, the GSEs are going to be taking on a lot more risk, so we can't take on more risk on the FHA side. But then, you're going to see a lot more loans go conventional. And then we hear from our members anecdotally, like realtors don't want to refer loans that are going FHA. They'd much rather see the loan go conventional just because they're easier, better chance they close. You got that dynamic. So a lot of moving parts, and hopefully the people that make the ultimate decisions on this stuff factor in some of this real world intel that's going on as well. But I don't know, Mike, Katie, any follow-up thoughts to any of that?
Rod in the chat brings up a good, interesting topic, that one of the tricky things about the FHA is the loan limits. And where you talk about risk and diversification of that risk, right now with the current FHA loan limits, I feel like it almost forces FHA into a loan of last resort, even ignoring all the other factors, especially in a market like ours. FHA is going to force you into very limited inventory on homes. So I think if you look to solve that problem some, it would actually decrease some of their risk, as it make FHA a little bit more attractive and not just, okay, I'm doing FHA because I have to.
Yeah, people still, when I talk to veteran originators who've been around the block a few times, maybe more than a few times, they still view the FHA program as subprime number 2, or, FHA, we don't need subprime when we have FHA. And when you have, Rich, I mean, you and I have talked about this inventory issue for quite a while. Do we really need to promote, do we really need to lower the cost of lending to the point where more people can buy homes, maybe arguably. But it's nice to have a cushion. So, but I'm showing my, my Depression era parents mentality. It's, save the money in the coffee can.
It's a good point. We see more and more things happening in our industry that are increasing demand when the supply side is what needs help. And good segue to the next headline I wanted to hit on, which is October home sale number came out yesterday, down 6.4% from September. If you look inside the numbers, really an inventory issue. Inventory in October overall is charted by Remax, down 13% overall from October to September, the 5th lowest level in the history of time they've been tracking monthly inventory levels. And also the average sales price continues to rise, right? Bad combo, I think it was up a little over 1% from September, but up over 12% from a year earlier. Inventory levels down 28% from last September, year over year. And there's been some news, some reports. Realtor.com did a survey that said a lot of people are going to start to list their homes during the holidays. But, right now where we're at is inventories are eroding back down towards these levels we saw in the spring that were like catastrophic, where you saw these crazy bidding wars and all kinds of madness happening. Katie, you are right in the epicenter of what Ivy Zellman called, I forget what she called it, but it's crazy.
The poster child of risk.
Yes, the poster children of risk.
Yeah.
Phoenix, Arizona, where the housing market is just popping. I mean, take us inside the Phoenix housing market right now, because you're right in the middle of it.
Yeah, so Mike and I are both right in the middle of it, but I was seeing something where the inventory went up 0%, and basically if nothing else came on the market, we would be out of supply in less than a month. And you can feel it in the house prices. And one of the issues that we have is, I think we talked about before, 13% of the listings are owned by iBuyers. So that's an interesting element that I wonder what's going to happen, with the whole announcement with Zillow last week. Is it going to open up some inventory to, the regular people that they were snatching up? But you have these astronomical home prices in addition to an inventory crisis. And what you have is people who are say, well, I'd love to sell my house, but where else am I going to go? And so they're not moving out of their homes. That's opening up inventory because they don't want to, spend the amount of money for what things are costing now in Phoenix. So it's just like we're in this stagnant environment where nobody's going anywhere, and not enough inventory is being built. So it's just like this ridiculous amount of things that rely on each other to solve the problem, and nothing's really moving. And so that's what, Mike, you can speak to that too, but that's definitely what I'm seeing on our end as far as inventory and the affordability problem.
We, of course, see very similar. And then especially with you out towards the Tempe area, I think you're seeing even more of that, because part of the big thing that's making such a crazy Phoenix market is that we have a lot of tech companies coming out here, and they're really moving out towards Katie's neck of the woods, as in Peoples in the Southeast Valley. And I think that's going to continue to cause it. We are lucky enough that we have the Cromford report coming out, and they collect some very good data based off of the Phoenix area and what's happening. And inventory levels are finally starting to get close to where they were last year before it started getting really ridiculous. But that's still half of what they were in 2019. And when you take a look at the trend lines, it's still going to be months and months of it slowing down on demand and still increasing on supply before you'd even hit a break-even point and start to go back towards normal. So it'll be a day or two more of fun.
This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Krisman. And this week, the heads of operations from two of our really great larger independent mortgage bank members, both based out of Arizona, Katie Klaus of People's Mortgage and Mike Metz of VIP Mortgage. And also making some news this week, Redfin's economist came out with their 2022 predictions, and I sent all you guys, I'm always on Reddit, and there was one of the guys on Reddit that's made some pretty good market predictions, found some things behind the scenes that seem to indicate that Amazon could have an interest in Redfin. Been a long time of people talking about Amazon entering the mortgage business, and I don't know, for whatever it's worth, it's if you're curious, go check it out. But Redfin, some housing market predictions, Rob. I'm going to throw some of these at you just to get your thoughts. Mortgage rates will rise to 3.6%. New listings will hit a 10-year high, but it will hardly make a dent in the ongoing supply shortage. Rents will continue to increase by another 7%. Home buyers will relocate to affordable cities like Columbus, Ohio, Indianapolis, and Harrisburg. People will vote with their feet, relocating to places that align with their politics. Condo demand will take off. Home buyers will take climate risk seriously when choosing a home. Housing policy will become central to political battles about climate change. iBuyers will focus on niches instead of market domination. And the DOJ will crack down on how real estate agents are paid. Any reaction to the Redfin crystal ball for next year?
No.
No? It's fascinating insight. Thanks, Rob.
Rich, that's why I make the big bucks, sending out a free commentary, Rich.
Mike, Katie, Carol, Rob.
No, I don't necessarily disagree with any of that. That's a whole litany of, we could do a show on each one of those topics for the next 12 months or 12 weeks. My big concern right now, Rich, is compliance. And I think Katie and Mike, we might want to talk a little bit about compliance. I mean, I'm not dismissing those projections at all. I think those are things that we've talked about for a great length on our shows. I don't disagree really with any of that. I think those are pretty safe bets. What I'm most interested in, I spent some time with Mitch Kiter last week, and he is just very cautionary about the CFPB and about mortgage operations in general, and fair lending and ECOA and the CFPB overstepping their bounds, or I should say, trying to expand its influence.
He had to be elated when Biden got elected.
What's that?
He had to be elated when Biden got elected.
Oh yeah. Yeah, I don't think he's dining at McDonald's for lunch. Maybe he is. No, he's actually a vegetarian. So, but I'd be curious about Katie and Mike in terms of your companies have you, and once again, Rich, I don't mean to dismiss those projections because I think they're all true, but I think the listeners might be interested from an ops perspective. What have your respective companies done or are doing with regard to, in today's commentary, I talked about the False Claims Act. They're talking about that again. They're talking about the taxonomy. They're talking about the CFPB and, governing by enforcement action. Rich has been talking about this all year. To Rich's credit, he's really nailed it. That we're entering into another kind of Richard Cordray environment, and the ops departments of mortgage companies, which include compliance and QC and so forth, they're just going to be under intense pressure to make sure everything's great. So I wanted to hear from you guys. What are you doing? What are you seeing? Is that a concern to you, or do you think all your ducks are in a row and you're ready for the CFPB to walk through the door?
Well, I don't think anybody's ready for the CFPB to walk through the door, but I was over compliance actually from 15 to about 18. And so I feel like we're going back to your point where the CFPB is now going to start doing regulation by enforcement. And so one of the frustrations back then was like, well, we want to do things right, but you're not giving us clear guidance on how to do them. And it's reverting almost back to that, where it feels almost like they want to get a gotcha. Like New York passed the CRA, requirements for independent mortgage bankers in the state of New York. They're talking about enforcing, fair lending big time. And, they're saying the automated systems in and of themselves are discriminatory. Like there's these things where we don't know how to solve for. We're trying to do the right thing, but we're looking for better guidance on what they want from us. That being said, everybody has, or not, I shouldn't say everybody, our company specifically has everything in place. We have the compliance management system in place. We have been on top of, everything that we need to do to be compliant. It's just volume took the place of making sure that we were doing everything that we needed to be doing. And all we're doing is taking a step back and saying, okay, let's revisit these things that were very important before. Let's get our internal audits on the books. Let's beef up our QC procedures, which really those didn't fall behind because we've been doing the same thing for years. Let's relook at our fair lending. Let's do regression analysis. Where can we have better outreach? And getting in front of our owners and getting in front of them and saying, okay, you guys, compliance is now is a hot button again. So we need to get together on this. We need to talk about what's important. We need to make sure we're doing everything. We need to increase the internal audits. So from our perspective, nobody stopped doing what they were doing before. It's just there's now an increased focus on making sure that we are doing and getting ourselves ready in the event that the CFPB were to come walk in the door. But it's disappointing on my end to watch them go back to doing things through enforcement, because again, we want to do the right things if you give us the tools and tell us how to comply. So that's one of the things I would like to see change. And not that I love compliance, but I think it's very important for a consumer, to protect the consumer. So I have no problem with it. I just want you to tell me what you want me to do in order to do it right.
A level playing field.
Yeah, exactly.
Tell us the rules. In other words, not to cut you off because I do want to hear from Mike, but I hear repeatedly from CEOs and owners saying, you know what, I don't mind competing on price. I don't mind competing on product. I don't mind competing, especially on service and reputation. But when I'm competing against somebody who, for lack of, point banks jump to mind, or LO Comp, or things that are kind of doing a little end around run on the rules and regulations that are out there. I don't want to compete on that, because what happens is a loan officer who is trying to decide, is out there looking for a job and go to company A or company B, and company A is adhering to the rules and regulations as the industry knows them, and company B is doing a little of this and doing a little of that because some paralegal thinks it's okay to do. Then that's what they don't like competing on. They don't like competing on compliance.
Right.
So.
Yeah, I'm sure Mike will speak to how many times we've heard the other company lets me do this. And then when you look into it, that's not necessarily what's really going on. But in some cases it is. And then it does create an uneven playing field. And it's just, well, they haven't gotten caught yet. But that doesn't mean that it's okay to be doing it.
Katie hit upon a good point, and it's one that we hit both from, your employees saying, oh, well, Peoples allows this. So the first thing we do is call Katie and say, does Peoples allow this? The other interesting one where it pops up a lot is when doing sales recruiting and you talk to them and you go over your policies and company policies. And sometimes they're just astounded. They're like, oh, no, we don't do any of that. That's never been a problem. And that's a tough one when you are competing on compliance and finding out that other companies, some of them are larger, just don't care about certain guidelines and don't get caught. And I think that gets even more interesting when you start talking about some of the increased enforcement that's going to be coming, similar to Katie. And I imagine most people, we want to do the things the right way. And it's just getting some of that clarification. If you look at what the CFPB has even released in the past year or two, though, for clarifications, you don't see a lot. When they have been responding on questions and hot topics, you see very vague updates that don't actually address what we were hoping to see for clarifications on hot topics. And going back to Rich's Redfin, where I'm interested to see, one of the things they talk about is fair lending. I think that's going to be an interesting one, especially as you bring up issues like, our company is going to start factoring in more climate risk. That's one where I was interested. I haven't seen anything on that. I haven't seen anyone really start anything with climate related risk other than FEMA changing the flood zones, which is just annoying on flood insurance, but we haven't really seen anyone doing anything for that yet.
Yeah, I haven't either, Mike, to your point. There's a huge population out there that doesn't think the climate is changing. And I tell them to call some South Pacific Islanders, but that aside, where it is changing is with regard to, is in the secondary market investors, the companies, the money managers, the funds and so forth that are buying loans, and what their opinion is about climate change. And that directly will impact rate sheet pricing. And are you going to make a loan to somebody who's in New Orleans when you continually get burned on whatever? I mean, we could talk about that for a while, but yeah, climate change is a different issue, is an interesting issue that I think will be continue to be an issue for the investors who are out there, because if they're not going to buy the loans because of the location of the property, then the lenders will have to price that in on their rate sheets. Northern California, with wildfires, flooding in Louisiana and other states, hurricane damage, cyclones, typhoons, lions and tigers and bears, the list goes on. So yeah, you raise a good point.
I'll be interested to see how that relates then to fair lending, because if you start just completely, I'll use the term redlining certain areas based off of climate risk, that's probably going to have some demographic relations to it. And how do you factor those in to fair lending analysis?
Yeah, that is going to be interesting, because there is a lot more coming there. I can tell you that right now. They're trying to just figure out how to use HMDA data and other data to, make sure lenders are, lending to all different types of ethnicities and income types, and something that's certainly going to be coming down the pike. Some good comments in the chat, and one on the regulatory front. I'm surprised the CFPB HUD isn't going after the real estate industry for discriminating on sellers for not allowing or encouraging FHA mortgages. Many times low to moderate income borrowers need to go FHA, only a matter of time. It's a good point. And a comment about Zillow selling their inventory to private equity partners. Not a good week for Zillow. They just got sued by one of their main shareholders as well for the allegation that they artificially pumped up the stock price and then pulled the rug out with the close of the iBuy unit. Mike and Katie, one thing I want to get your guys' thoughts on, though, is volume is starting to drop off. You talk to mortgage lenders. No, nothing's dropping. We're going to do the same business as next year, last year, next year. But you just look at the stats. I mean, refis really have dropped off. We saw home sales, the numbers we talked about earlier in the show in October. I don't think it's going to be like the winter of 2018, but we're heading towards a winter that is going to be almost certainly less busy than it's been in a while. As operational leaders, guys, over hundreds of people likely, you start to take a look at, the ups and downs of our business, the seasonal typically drop off of volume in the winter. Then you have all this technology that's emerging. Peoples and VIP, both very tech forward companies. You guys are working with lots of tech that is starting to automate things that were human before. Just how you manage that whole dynamic as leaders going forward. It's got to be if I was running operations right now for a big mortgage company like guys, it's something that would probably be keeping me awake a little bit at night. And would just be interested in your guys' perspective. Katie, we'll start with you.
Yeah, I mean, some of it's a little bit of a relief, honestly. I mean, we've been full gas since April of 2020 with no breaks. So the scary part is what's to come, right? So it's nice to be a little bit slower than we were previously, but I also know on the other end of that, it could be very slow. We made it through the housing crash. And so I know what it's like to close 70 loans in 1 month, as opposed to 70 loans in 1 day, which is what we're used to, for the last 18, 19 months. But we're having a lot of them are working with the sales staff. We're doing some new trainings as far as get back out to your agents, new affordable lending products that they can sell. We do a lot of training on those, on DPA products, kind of pushing our sales staff back to selling purchases instead of, closing whatever is falling into your lap. And then from an operations standpoint, this is kind of a good time to implement some of those changes, because when you're so busy, you can't do things that will disrupt, the volume. I mean, people are barely getting their day-to-day work done. And so a lapse in volume allows us to implement some of these new changes. And so, we started on the hybrid close. We're going to close the first full e-close by the end of the year, beginning of next year. We've rolled out a few new tools that they're going to use. And so they have time to sit down and learn those things now that the volume isn't as high as it was before. So I'm looking at the lower volumes as opportunity, but there is a lot of concern as to how slow is it going to get, especially if rates increase the way that they say they're increasing, because nobody who has a 2.125 interest rate is going to be refinancing anytime soon if that's the case. And so that's a large customer base that will not be coming back to the table for a while, for lack of a better term, saying. So
and we've seen it, like from the members, we just hear like there's a fervor of, okay, now it's time to implement e-close. Now it's time to change LOS or POS, or
right.
Make this structural change, or grow or start this new channel of volume. Again, good point on the relief, because it has been just fast and furious for a while now. Mike, how you looking at that issue in general?
Again, pretty similar in that regard. We've seen that. I think we're going to see purchases stay steady a while, at least in our markets. Again, the supply is so much lower. It doesn't matter if the demand is fluctuating a little bit or decreasing a little bit with the increased interest rates, or just with the seasonality. I think that's going to stay steady for a while, just as supply allows. Refinances, though, definitely dropping down. So I think, like Katie mentioned again, that's going to continue. I don't think we're going to see rates dropping anytime soon, and people aren't going to be as excited to refinance out of their sweet 2% rates, even if now they have the option to take some equity out of the home for a project. I think they'll probably look for the HELOCs, as dry as that market still is, but they'll take a look at other options instead of losing their big rate. On our side, on the tech side, Rob has mentioned it a few times in his newsletter, and I think it is a big thing, is we know what comes next. Is you're going to see, as the volume falls, the margin compression get more and more intense in those wars for the remaining files. And all of a sudden, realtors that have been able to enjoy some peace and quiet for a year and a half are now all of a sudden getting donuts for the third time in the day. And I think now is the time that you can start to look at implementing technology, or kind of in that happy groove where things are relatively steady, which is a good time to test. But the question is, what's going to get you that ROI? Not all technology is actually going to help change your bottom line or actually impact margins. Some of it may just be quality of life, which is nice, but what's going to help you in being more competitive, and what's going to help in either preparing for some of those audits and cleaning up your loan flow, or what's going to help you with more scalability. And if you can, try to find one that allows for all three. But it's a serious vetting process.
Work from home with, the rise and fall of just the pandemic numbers. You guys just both officially work from home. Rob, you had a question. I'm sorry, Rob, his hand up.
Well, is there a patrol? The lights stopped blinking behind you there, Red. I thought maybe there was a state trooper outside your door there because the lights were like it was flashing.
They just come by Fridays around this time. Yeah.
All right.
He gets
sorry.
unruly.
I didn't mean to interrupt. Go ahead.
Work from home, Katie, you guys, have you given up on mandating in the office? Where are you guys at with that?
We actually have about 50 to 60% of our corporate ops staff, maybe a little bit more. They're on a hybrid schedule. We had a lot of them in the office through the pandemic, just because people were so sick of being home that if they didn't have kids to school, they came in. And we have a lot of long-term employees that like being with each other and like being in the office. I'm in the office right now. My owner just walked in and I was like, I'm recording live, and he tried to give me a joke. So that's awesome. But yeah, I got to spray the other owner with champagne the other day because he became a grandfather. So like, we like to have fun, and there's a lot of people in the office, but we have had challenges recruiting new talent because a lot of people do want to work from home. And so it's been a tough transition for myself and for a lot of my senior manager team, because we're used to, having people in the office, and we've had to make that change to allowing them to work from home. And I think it's been good. And I think, a lot of them enjoy working from home, but we do have a lot of staff that is hybrid and still coming into the office a few days a week. And it's helped with morale and keeping people excited. And that's from my perspective. I think Mike might be different, but.
So about half the people in the office some of the time. And yeah, we're trying to hire a couple people right now. Just been interviewing a lot of people, and people really want to, at least people I'm interviewing, they want to work from home. If they work for companies, at wholesale that make people go into the office, you have a real opportunity, I think to recruit those people. But Mike, work from home. You guys have always been work from home, right?
We have had a far more lax policy on that one, and Katie's probably about double the percent we have that have been going back to the office. I think the sales folks are the type that do not like sitting in their dark office with the glow of the monitors on their face. So they were the ones jumping to get back into the office as soon as possible. There's a lot of operations people that when I talk to, they're just flat out, no, I don't want to have that hour and a half commute back in my day. I'd rather sit at home and continue working and rocking out to Pearl Jam all day while I go through loans. A lot of our best hires during that crazy period were people who were forced back into the office. So that kind of reminds me, oh yeah, that's not necessarily one where you want to play chicken in that particular category. So we've adopted opt-in, hybrid, but I think we are kind of just planning on, hey, we'll continue remote and the hybrid and the opt-in for it, for at least for now. A lot of other companies where I talk to, the big hanging thing is what's going to happen with the vaccination mandate and how that happens for working from the office versus working from home and how that affects their employees. So I think that'll be a pretty big dictator on how that goes for a lot of companies.
Rob, any final questions or thoughts for Katie or Mike? Any big plans you got this weekend?
Playing basketball tomorrow morning.
Your Warriors beat my Cavs last night. I was going to text you because the Cavs were up in the first half, and thank God I didn't. You would have been.
Yeah, we could. Yeah. So yeah, I do have a question for Katie, Mike. I know we're out of time, but going to the Warriors, it's interesting, Rich, when I travel around the nation and people say, oh, are you a Warriors fan? I say, yeah, I'm a Warriors fan. Inevitably, what people say, people will always say, I really like Steph Curry. I like, no matter if you hate the Warriors, they're the enemy. People like Steph Curry. And my daughter's boyfriend does video for the Warriors, and Steph Curry, he says, is what you see on TV. He's just a nice, normal guy.
What about Draymond Green? He punched LeBron in the nuts. It got us a title. I love him for that reason alone.
Draymond is the spirit of the team.
Right.
Spirit of the team. But one quick question, Katie, Mike, I don't know the answer to this. Are you allowed to ask somebody if they've been vaccinated or not?
I don't think so. No.
Okay.
That's
All
what
right.
we're going with is don't ask.
Yeah, we don't
ask,
ask either.
tell.
There's attorneys asking that question, and I'll let them figure it out first.
Yeah, we're ops, not HR. So I
Yeah.
no, I don't know.
Okay.
Katie, Mike, any big weekend plans?
Flying out towards Charleston.
Oh yeah, that's right.
Oh yeah, that'll be so fun. A bunch of kid stuff, you know, they ruin everything. You got soccer, basketball, all that fun stuff.
All the kid events. Yeah, I just left that phase of life, but
Yeah.
yeah, it was about a decade of it. So, but cool.
Hopefully watching the Cardinals not lose. We'll see though. 90% of their team's on injury reserve, it feels like. So we'll see what really
They
happens.
were flying high and 7-0, and now everybody's hurt, and
Their JV team had to play on Sunday, got beat down. It was embarrassing. Felt like a Browns fan.
right. Ever since they beat the Browns up, it's been all downhill from them.
Yeah.
But we'll see what happens down the stretch. So, well, Katie, Mike, thank you very much for
Yes,
jumping
thank you
on
very
and
much.
joining us. Always enjoy chatting with you guys and getting your perspective on our crazy industry. Really appreciate you joining us.
Thank you for having
Thanks
us.
for having us.
Absolutely.
you.
Rob, as always, great to see you. We're off next week because it's Thanksgiving Friday, but then we're coming back 3 special editions in a row of the Rundown during the 12 days of TMC, which is a legitimately awesome event. The agenda is linked in the chat. It's something really cool we do as kind of a gift back to our members every year in December. So if you haven't checked it out, check it out. And yeah, thanks.
Rob, are you going to be able to get a Steph Curry advertisement for the 12 days of TMC?
No
No pressure.
I'm in the camp that loves Steph Curry. They beat us in the finals a couple of times. He's dead to me. I'm sorry.
It's amazing. You just, as a fan, you just take it for granted that he's going to come out and make these shots that you think, like if you were on a basketball court, there's no way you would even come close to that. And he's just swish. I mean, it is amazing.
That's why I don't like him or the Warriors. So there you go. I'm both.
I prefer to focus on Kyrie burying that 3 right in his face to win the title. Is my image of Steph Curry, but you guys got us more than we got you.
Anyway, know that he's a nice guy.
Yeah,
He's a nice guy.
he seems like a nice guy. So, and a good golfer too. So,
Yeah.
All right.
all right, guys, have a great weekend. Thanks again to our attendees. We'll see you in 2 weeks on the Rundown. Have a great Thanksgiving holiday, everybody. We'll see you then. Take care.
See you later.